Okay, we're going to talk about the subject that matters the most to the markets. The only one that really matters, actually, when you think about it, QE3. Are we going to get it? Are we not going to get it? You might have gotten a couple little clues about it today. Spencer Jakab is here with the story. Morning, sir. How are you?
Good morning.
All right, QE3. When's it coming? You want to be a good columnist? You want to be one?
Tell us.
Tell us.
Right,
when is it coming?
Ben whispered in my ear. Look, QE3 is a very complicated issue. One issue
We're talking,
complicating
of
it
course,
is
about
inflation.
the Fed's bond buying program.
Right. We're not talking about ships. We're not talking about the British royal family. We're talking about, you know, the.
Will the Fed implement another big bond buying, another liquidity flush?
That's right. And they've had three things since the crisis, right? They had the original QE, which was the round of bond buying that began in November of 2008. They had QE2, which was announced in August 2010 and began a few months later. Another round of bond buying, and the most recent one, which is still ongoing, it doesn't expire until June, is Operation Twist, which doesn't involve fresh printing because that was seen as controversial, but achieves similar thing by selling short-term and buying long-term and forcing down the yields on those longer-term bonds. Now, they've done all they can do on that front. So if there is to be a fresh round, it will have to involve actual money printing, which is more controversial. Isn't necessarily so different if you speak to economists, but is more controversial. Right. And the green light for that depends on inflation. Which, getting back to the report today, this morning, and the big one tomorrow.
We have consumer prices tomorrow.
Right. And it looked like, okay, so the headline on the PPI today was flat.
Right? Yeah, which was lower than expected.
That's the month-over-month number.
Where it excludes the volatility, was actually a little bit higher than expected.
That's right.
What is that telling us?
Well, it's telling us, so it was the reverse of what was expected, right? The core was expected to come down a bit, and the headline numbers are expected to be a little bit higher mainly because of energy. And the headline figure was surprisingly low, which is good. And the core figure was a bit higher mainly because car prices and things like that. There's a bit more pricing power in the economy. Tomorrow's number matters a lot. Tomorrow's number is expected to come down to 2.7% growth year on year in consumer prices. And the core is expected to be a bit lower. And so, you know, these two figures, the bottom line is it gives more of a green light if the Fed were to act. But what has prompted the Fed to act hasn't been inflation. I mean, that's kind of given them carte blanche to do something. This twist happened in an environment where inflation wasn't coming down too much year on year, and so they did twist instead, which is not really less inflationary, but it's less controversial.
You said consumer prices are up about 2.7% from a year ago.
That's the expectation, yeah.
That's above the Fed's preferred level, isn't it?
Well, yeah, and they look at something called the PCE deflator. I don't want to kind of get into a whole, that's a related measure of inflation, but they don't care. As long as the trend is down, that makes it much easier for them politically.
Not too far down.
But not too far down to act. What's prompted them to act, though, in all those three prior cases, has been asset prices coming down, the stock market. And so you had, you know, if you look at the kind of the 4 months prior to each round, you had in 2008 a huge drop. You know, the stocks were down by a third and weren't finished going down. In August 2010, they were down by about 14%, and just before Operation Twist, they were down by about 12%. Now they're only down a couple of percent from the recent peak. So really, what might prompt them to act is the market selling off. You know, that's the bottom line.
This is a big picture question I want to leave us with here. Is there a limit to the Fed's power?
There absolutely is. As a matter of fact, the Fed's powers are exaggerated because their real power is to inflate asset prices. The actual economic benefit from subsequent rounds of quantitative easing is not going to be that great because bond yields can't come down that much more. And you know, there's this idea that they're printing money and showering it on the economy. That's not really happening, and you have to really, you know, look at what they can do. And it's a more of a psychological impact and a wealth effect that they create. And if people stop believing it or see it as fleeting, then the sugar high is not going to last as long, and their power diminishes. And it's exaggerated as it is. It's like the Wizard of Oz. You know, they can't really, you know, they can make you feel good, but what they can actually do is kind of hitting its limits.